Howdy everybody, welcome back to Accounting 1101. Professor Martin here with you as always, coming from Wilmington, Ohio. And if you've been following along in our video series, you know that we've been working through the accounting cycle. And we've made it all the way to the part of the accounting cycle where we have completed an adjusted trial balance. Now that means we've taken the regular transactions that happened during the month, we've journalized them, we've posted them, we've created an unadjusted trial balance, we've looked at the records in the accounting books, and we've said, okay, we've got a few adjustments that we need to make the accounting records reflect reality at the end of the period. We've made those adjusting entries, and we've created an adjusted trial balance. And so we've worked almost all the way through the accounting cycle. We've come kind of to the end here where we're going to make financial statements out of that adjusted trial balance, and then we're going to make closing entries. And then guess what? We have completed the entire accounting cycle. So let's get right to it. As I mentioned, to kind of summarize where we've been, we started off talking about the accounting equation. Assets equals liabilities plus equity. And we talked about how transactions kind of fit into that accounting equation and how they impact the accounting equation. And that was way back in week number 1. And we've talked about the rules of debit and credit. We introduced the idea of T accounts and double entry accounting. We practiced journalizing transactions, posting them to accounts, and then we ended up with the unadjusted trial balance. Then the following week we talked about adjusting entries and the types of adjusting entries that we had, and we made those entries, we posted them, and we came up with the adjusted trial balance, which looks a little bit like what you see right there. Which brings us to today. How do we get financial statements out of that adjusted trial balance? Well, the answer is it's pretty simple. We're going to talk about how we make 4 financial statements. The 4 main financial statements. We're going to show you how to make the income statement. We're going to show you how to make the statement of owner's equity, the balance sheet, and then later on, in a couple weeks down the road, we'll talk about the statement of cash flows and how that comes together. It's a little bit more involved. We're going to punt that to the end and worry about that later on. But right now, we're going to use our adjusted trial balance to make an income statement, statement of owner's equity, and a balance sheet. And we really got to tip our hat to the old trial balance here, because our trial balance makes putting together the financial statements really easy because of the way that the trial balance is organized. If you look, we have all the balance sheet accounts here at the beginning, and they're in the order that they appear on the balance sheet. Cash, accounts receivable, supplies, prepaid insurance, land, equipment, accumulated depreciation, then on to the liabilities and the equity. And so right off the bat, the trial balance is going to make the balance sheet really simple because it's already organized in the order that it needs to be in for the balance sheet. And then down here at the bottom, you can see the income statement. It's organized in the way that it shows up on the income statement. We have our revenue at the top and then our expenses in the order that they're going to appear on the income statement. And so if we have a good adjusted trial balance, making financial statements is going to be pretty simple. We just pull everything off the adjusted trial balance and throw them into the financial statement. So the income statement, a little bit of a review. Revenue minus expenses equals net income. Ideally, if we have more expenses than we have revenues, we will have a net loss, which is bad. Businesses don't stay in business too long if they have net losses period after period, quarter after quarter, year after year. And I'll give you some examples. Circuit City. Y'all remember Circuit City, or am I too old? Circuit City was an electronics store. It was really Best Buy back in the day. Before Best Buy really came along and started growing, we had Circuit City. Circuit City's gone. And before that, we had Radio Shack, right? How many Radio Shacks do you see out there? Blockbuster Video, another example. And more recently, Bed Bath & Beyond. If you lose money quarter after quarter, year after year, eventually you will go out of business. So how much money did the business make during the period? That's the question we're trying to answer on our income statement. And again, we can make an income statement for a month, for a quarter, for a year, whatever time period we're trying to look at. That's the idea behind our income statement. So how do we get from here, our adjusted trial balance, to the income statement? Well, like I said, we isolate that bottom part of the trial balance where we have our income statement accounts, and then we just kind of plug them into the format for the income statement. You can see we have revenues, fees earned, rent revenue, and then we sum them up and get a total revenue amount. Then we have all our expenses. They're all right there. We just pull them over one at a time, add them up, we get total expenses. So revenue minus expenses gives me a net income. Now, the income statement we're making right now, just kind of starting out in accounting, is called a single step income statement. One step, revenue minus expenses equals net income. And so that's just one step. We group all the revenue together, we group all the expenses together, and we get net income. As we progress, and as you look at financial statements from publicly traded companies, you'll notice it looks a little bit more involved on the income statement. You'll have different milestones of income. You'll have a line for gross profit for a retailer. You'll have sales minus cost of goods sold, and then gross profit that shows how much money that the company has made just on selling the product. And then you'll have operating income. Maybe you'll have income before taxes. So you'll have different milestones in that income statement that an investor can quickly look at and see how the company's doing. And we call that a multi-step income statement. So if you're looking at publicly traded company financials and you're looking at their income statements and you're like, boy, this looks a lot more involved than what we're doing. Well, it is. It's a multi-step income statement. We'll talk more about that multi-step income statement later on down the road. But for now, all we really want to know about creating our income statement is revenues grouped together, expenses grouped together. Revenue minus expenses gives us net income. That income statement is going to lead us into a statement of owner's equity. And a statement of owner's equity shows our changes in equity from the beginning of the period to the end of the period. At the beginning of the period in our fictional business, we had no capital for the owner because the business hadn't started yet. The owner invested $25,000. We add in the net income for the period. We subtract out what the owner took out. Or if we're talking about a publicly traded company, we subtract out dividends, and that gives us our ending capital amount. And so we have to do that income statement before we do the statement of owner's equity, simply because we need that income statement amount. And then that ending capital balance, we're going to carry that over to the balance sheet. Balance sheet is a statement showing us the accounting equation. Assets equals liabilities plus equity. And it's going to show us what the business owns and who has a claim to it at a specific point in time. And so now we're at that top part of the trial balance. Again, the balance sheet accounts are listed in order as they appear on the balance sheet. So all we got to do is pull them over to the balance sheet. Now, the balance sheet is a little bit more involved than our income statement simply because we're doing a classified balance sheet. We're breaking things down between current and non-current, both on the asset and liability side. And so let's go in a little bit more depth and kind of explain what current and non-current means as we're looking at the sections of that balance sheet. So here's my balance sheet. Again, the accounts are thrown in the order that they appear on the trial balance. At the top, we have current assets. Current assets are assets expected to be converted to cash or used up within a year or less. And so you think about cash. Generally speaking, we'll burn through that cash within a year. Accounts receivable, we expect to collect in maybe 30, 60 days. So that's well within a year. Supplies, we expect to use up within a year. Prepaid insurance, and we expect to use that up probably within the year. And so current assets are any asset we're going to be converting to cash or using up within a year. It's current. We move on. We see we have property, plant, and equipment, aka fixed assets. We talked a lot about those when we did our video on depreciating adjusting entries. Sometimes we just show it as one line, like property, plant, and equipment net of depreciation. In our examples, we're breaking it out in between the various items. We have land, office equipment, We're subtracting out what we've depreciated, accumulated depreciation, and then we have the total property, plant, and equipment, which is the sum of land plus equipment minus accumulated depreciation. And so property, plant, and equipment will be the next section of your balance sheet. And now as we look at some of these publicly traded companies, we get a little bit further down the road, we'll see things like intangible assets, we'll see things like long-term investments. But right now, we're just keeping it pretty simple, current assets, and then property, plant, and equipment. Add those two together, we get total assets. Again, total assets, everything the business owns. Total assets. Then we have our current liabilities. Similar to current assets, they are liabilities that we expect to pay off within a year. And so they're liabilities that are due to be paid off within a year or less. Accounts payable, wages payable, unearned revenue, we'd expect to pay those off or satisfy those liabilities within a year or less. And we'd also have long-term liabilities on a lot of balance sheets. In this example, we don't have any long-term liabilities, but long-term liabilities would be liabilities that we would expect to pay a year or more down the road. You think about mortgages payable, long-term debt like bonds, that would be a long-term liability. Sometimes in the current liabilities, you'll see the current portion of long-term debt. The part of that mortgage that is due within the year, the part of that bond that is due within a year. But a lot of times you'll see current liabilities and long-term liabilities. You add the two together, you get total liabilities. Our final part, owner's equity, is literally what's left over after we subtract out the liabilities from assets. It's a residual interest represented by the owner's investment into the business. So owner's equity, the rights or claims of the owner to the assets of the business. For proprietorship, sole proprietorship, we would have a capital account for the owner. If it was a partnership, we would have a capital account for every partner. In a corporation, we'd have common stock. And we'll get to corporations a little bit later on. But right now, we just have one owner, and his investment is represented by the capital account. Finally, I mentioned a statement of cash flows. We're not going to prepare one right now, but what that statement is doing, it's going to show you dollars in and dollars out. It's going to show you the change in the cash balance on the balance sheet from one period to the next. You can kind of see here at the bottom, we have cash at the beginning of the period, we have cash at the end of the period, and so we had an increase. The statement of cash flows is going to show you how that increase came about. The dollars that came in or out from operating activities, investing activities, and financing activities. So it's broken down by the three main business activities: operating, financing, investing. It is our only cash basis financial statement. All the other financial statements we're doing are done on the accrual basis. We do our accounting on the accrual basis, which makes it very easy to prepare the other three financial statements. The reason we're punting the cash flow statement to the end is because it's done on the cash basis. In order to do the cash flow statement, we've got to strip away all that accrual accounting that we've done where we've recognized revenue and expenses even though cash hasn't changed hands. Because the statement of cash flows is done on the cash basis, we got to get rid of all that accrual accounting, which takes a little bit of work. And since I'm lazy, and from an accounting standpoint, we're going to do that work at the end. We're going to put it off till the very end. We have one more video this week talking about closing time. Y'all remember that terrible 90s alternative song, Closing Time? We're talking about closing down the bars or closing time. We're going to do closing time. And we're going to close out all the income statement accounts. We're going to reset the scoreboard so we can play another accounting game. And I'm going to show you that process in our next video. It's going to be really the final step of the accounting cycle. We're going to close out certain accounts and make a post-closing trial balance. And hey, we have completed the accounting cycle. And it'll be time to practice the entire cycle a few times and make sure we got it down. So that's coming up in our next video. As always, if you have any questions about anything you're seeing in the homework, anything that I've talked about in the lecture videos, I'd be happy to help and help you work through any issues that you're having. Just reach out to me and we'll see what we can do. One more video this week on closing time. Hope to see you back here for that. Until then, take care, everybody.